Welcome to Markets Now. I'm Michelle Rook with Oliver Slope of Blue Line Futures, and livestock closing higher for the most part on Friday with the grain trade mix. Corn higher, soybeans and wheat setting back. And Oliver, boy, it has been a roller coaster week with on again, off again tariffs. And, when do we start trading the fundamentals of this market?
Well, hopefully sooner rather than later. I know there's been a lot of comparison of, this particular cycle that we're in with the tariff talk to the 2018 tariff talk, and then the Russia-Ukraine invasion. Eventually, the market, I think, will grow a little bit more numb to it. But right now, there's just so much uncertainty, and the markets don't like uncertainty, and that means they're very reactive to pretty much any headline out there. But again, we get a couple weeks under our belt here. I think that we'll be able to focus on the more fundamental backdrops, and that's going to be the big prospective plantings report at the end of the month. That's always a big one. And then past that, we're talking about weather in the U.S. So I think seasonally, we start to see volatility rise in the grain markets into the spring and summer. Tariff talks have definitely expedited that. Recently, it's been, I'd say a bit of a trader's paradise, which is shorter term opportunities for participants on both sides of the market. Eventually, I think the hedgers will have their day where we can focus in on those fundamentals. But I think for the next week or so, a lot of shorter term opportunities out there.
Right. So you've been looking a lot at and trading money flow as well as the technicals. How do producers keep in the market and not get chopped up?
Well, options are a great tool for that. Volatility has upticked. We have the CVOL for the corn market reaching its highest level since last summer. So the options have picked up in premium a little bit, but the ranges have expanded too. For corn this week, we had a 31 cent trading range and a 36 cent trading range last week. The average daily range over the last 2 weeks is about 11.5 cents. So options are a good way to give yourself that downside protection while kind of just sleeping peacefully at night, not worrying about what headlines came out overnight or over the weekend. So I think options are a great tool. The corn market is in an interesting spot. The risk obviously happened really fast, and we fell very sharply, very fast. Nice to see some corrective buying here this week. And if you zoom out, we're basically unchanged on the week. So we ran really fast and didn't really go anywhere. So if we can get out above that 470 level, I wouldn't really be surprised to see this market continue to see relief towards 480 to 485. That area represents the 50% retracement from that recent range, as well as the 50-day moving average. If we get up there, I think producers will want to use that to be a little bit more proactive in playing defense on price.
What about wheat and soybeans? Because we did take out some key moving averages there that we haven't gotten back above, right?
Yeah, that's right. The soybeans are interesting here. We're a little bit more hesitant to be optimistic on the front month May contract. We do see some value out in the new crop November, which actually held pretty well today. So that was nice to see. The volatility in soybeans relative to corn, not as high of a spike there, but these trading ranges, again, are really pretty opportunistic for shorter term traders. I think soybeans had about a 45 cent range this week and a 36 cent range last week. And now we're staring at some key technical levels. 1035 to 1042 is the inflection point for May soybeans. That pocket represents a key retracement from those December lows to the February highs. And it's also the 50-day moving average and breakdown point from February 28th. So if you're optimistic on soybeans, you really want to see consecutive closes out above that 1042 level to propel us towards 1060 to 1070. And again, if we see continued relief, like we would expect in corn, we get that relief rally from here. I think you want to be more proactive and play some price defense. Seasonally speaking, for these grain markets, March can be a very choppy time of year, and these trade headlines really kind of favor that as well. A lot of shorter term opportunities.
Yeah, but even if you got the tariff headlines to, slow down, or we got some resolution, what would the likelihood even be of going back to those February highs that we hit?
I would think that we would probably need a bigger fundamental catalyst to get us out there, especially in those front month contracts for soybeans. Potentially something happens that would be friendly with trade with China. That's kind of the big question mark over the market right now that I think will probably keep the upside limited. But China's economy had been slower over the last year or so. It looks like it's starting to turn a corner. And part of me wonders if China won't be a little bit more welcome to the idea of making some sort of negotiation with the United States to keep their economy turning the corner and going in the right direction here through the remainder of the year.
Yeah. So you mentioned the prospective plantings report, and certainly a lot of talk out of the Ag Outlook Forum of 94 million acres maybe being the low water mark for corn, and soybeans might actually see 84 as the high mark. What are your thoughts?
Yeah, at the end of the day, I think the American farmer loves to plant corn, and I think the corn acres probably have a little bit of room to grow there. And that's kind of what makes me a little bit more friendly on the new crop November soybean contract. If acres come in low there, I wouldn't be surprised to see the money flow start to slide into soybeans. Obviously, funds have been moving a lot of these agricultural markets. They were very aggressive in their corn buying spree and obviously very quick to exit as well. They started to dip their toes in on the long side of soybeans with that rally, and buying spree has since been halted. But if we're able to get a friendly print there, I wouldn't be surprised to see the money find a place in soybeans and even wheat for that matter. Wheat's been a very underloved market for the funds and managed money here as of late. Hasn't held up as good as we would have liked to this week, but potentially there's some upside momentum there, especially if we see that U.S. dollar continue to soften up. When you look at correlations with the currencies, wheat is usually the one with the more in tune inverse correlation with the U.S. dollar. So if the dollar softens up, I would think that would be a little bit more favorable for wheat. It did a pretty good job at the end of the week defending 540 to 545. The big hurdle on the upside, though, 565 to 570. That was previously important price points, a key retracement from the February highs, as well as the 50-day moving average. If we can see wheat out above 570, wouldn't be surprised to see managed money start to cover some of that short position they've been holding on to for what seems like a lifetime.
No doubt. So the WASD on Tuesday, that should be pretty quiet or benign, right?
I'm not expecting a whole lot. We'll probably see some knee-jerk reactions in that report, but I think we quickly move past that and focus on the report at the end of the month, certainly.
What about the cattle market? Huge update on Friday here, and we did have some higher cash trade pushing it, right?
Yeah, the cattle market has surprised me really throughout the whole week. While the outside markets were selling off, cattle opened the week lower, but managed to rally back. I mean, live cattle trading in a $10 range, about $10 off of the early morning or the early week low. That was extremely impressive in the face of a risk-off trade in the outside markets and a counter-seasonal rally on top of that. So that was constructive. That 200 area for April live cattle is going to be a big inflection point. I think psychologically and technically, potentially the market sees a little bit more follow through and upside, but really feel like you get to 201, 202, and that's probably a pretty decent spot to look at protecting the downside risk in the April live cattle and feeder cattle as well. A pretty impressive week. Counter seasonal rally. We got out above some big levels, which was really impressive. The feeder cattle, I've been kind of reminding folks here recently that the ranges have been so wide. We talked about the $10 range in live cattle and a big trading range in feeder cattle this week. And this kind of on a percentage basis, it's really not a whole lot different. A $10 move now from these levels at 280 is about the equivalent to a $5 move when we were trading at 140. So the ranges are wide, but they're relatively comparable to what we saw just, for better part of the last 10 years were the levels we were trading at.
So as well as the cattle market held together with the meltdown in the stock market, does that leave you some confidence the funds are going to continue to defend their long there?
It certainly seems like there's some good underlying strength in that market. When you have a counter seasonal rally and buying in the face of outside market panic, and you see cattle market rise, typically you see a 10% correction in the stock market and you see the cattle complex follow it. The fact that we saw not only hold ground, but actually gain ground was extraordinary. And I think overall it highlights the underlying strength that we have in this market going forward. But again, I think we start to chew a little bit higher and you're going to probably want to revisit some sort of protection to the downside.
Absolutely. And the hog market got beat up a couple of days just because of the Mexican tariff concern situation. But that market, do you think we're starting to maybe try to forge out a bit of a low there or not?
Yeah, we had kind of a shorter term capitulation low and a V-shaped recovery this week with prices working back to really where they accelerated lower last week near 87 to 88. That also represents the 50-day moving average, which I feel like I've mentioned in about every market. These moving averages seem to be a common theme for a lot of these shorter term traders and algorithms out there. So 87 to 88 in that April contract is going to be a big level to keep an eye on into next week. Seasonally, we can see the market stabilize here through the middle of the month before tailing off. So I think if we get a couple dollars higher from here into next week's trade, it might be an opportunity to look back to the short side, especially if the funds continue to unwind that net long position, which got very, very large. Obviously, it looks like they bought some back this week, but I wouldn't be surprised to see that trend of long liquidation continue in that market.
All right. Appreciate your analysis as always. Oliver Slope, Blue Line Futures. That is Markets Now.